to start out, I understand your career, you started across the road at the exchange, is that right?
Yes.
That was your very first experience with investing?
Yeah.
What was that like?
That was interesting. It was the big boards were still there. Some of the companies were still listed and had the chalkies and whatnot. But I was in the options market, which was just a bit to the side of that. And so there was all the characters who were around in those days in that business. It was just an interesting, you didn't really learn much about investing, so in any great detail.
It was the transaction.
It was transaction. It was just it was an exciting sort of thing, and it got me more interested.
You made a comment that you felt like that was where you learnt the difference between an investor and a trader, and that's where you kind of figured out you wanted to become an investor.
Yeah, absolutely.
How do you see the difference between the two?
Well, I think an investor has a different mindset and a different time frame. A trader, obviously, is, as the name suggests, is looking for the quick,
simple in and out.
He's looking for the simple trade, and that's difficult to do, on a consistent basis and be successful at that. I think, investing is a much longer term, more work needed, and obviously with that, more looking at psychology of markets, of other investors. There's a lot more where value, I think, can be added over time. Wherein I think trading is, as we've seen in markets, it's come down to the milliseconds these days.
Yeah, it's interesting. A lot of the managers that I speak to feel like having a longer time frame is one of the few advantages that investors have in a market where information has become a commodity. You're competing against machines. Having that longer view is where you can actually start to gain some advantage.
Exactly. So my great colleague John Sevior, who I've worked with for 20 years, he has a great analogy where, back in the, years ago when we probably first started out, investing was a test match. It was a 5-day game, and then suddenly it became 1-day game, and nowadays with the machines, etc., it's 2020.
Yeah.
So for a investor, for a real investor to add value, you need to take that longer term view, because we're seeing, you're seeing stock moves are quite extraordinary.
Yeah.
Intraday, stocks will move 5% on the sniff of a bit of news, and an interesting stat is that in the last 12 months, the top 50 companies, their high-low or low-high, whichever the way it may be, is a range of about 40-odd%. Companies aren't changing by 40-odd% in a year, but their share prices are. And I mean, that's both a threat and an opportunity for an investor. But because these volatile moves are happening on a day-to-day basis, by doing the work, applying good investment principles, you can, you add value over the medium to longer term.
We're going to get into some of your current views in a bit. I just wanted to touch on your time at Perpetual, and you worked alongside John, and there's a whole number of really great fund managers that have come out of Perpetual over the years. How did that influence the way that you invest today? Who were some of the big influences on you, and what were some of the things that you took out from your experience there?
Yeah, I mean, it was a great experience, a fantastic company to work for. So I started there in the early 90s, and John Murray and Peter Morgan. So John Murray went off to form Perennial, Peter Morgan at 452. So some really good names. And then John and I were working there together post the departure of those two guys. So it was where my sort of view on investing came about. And it was back when investment processes were sort of starting to come into the vogue, and you had to enunciate what your sort of process was. And so we were part of the team that sort of put together what became known as the Perpetual sort of process. And we had a lot of success over 20 years. So it was great. And then I think John and I, one thing we did quite well is we were good at then gathering a good people to come through the team, identifying talent and bringing them through, and and you've seen some of them go off again to start their own fund management businesses. And so that's, it was a great experience and a great place to work, and I've been very, very fortunate and very, very lucky, I think, to have sort of fell into that role back in the early 90s.
Have you evolved how you talked about coming up with those principles and forming the ideas during that time with John and some of those other managers? You're now at Airlie. Have you evolved the way that you invest? Because my understanding, and correct me where I'm wrong, is that Perpetual is a very the black and white on value, I would say. Whereas Airlie, it seems you're a bit more progressive in terms of happy to own some slightly more perceived expensive names, but you'll take a longer view on where those earnings might kick in down the line, and you're happy to pay a slightly higher multiple for some of the businesses that you own.
Well, I like to think, I've become a better investor as I've gotten older. I think, and that should be the way it goes. You get more experience. You've seen a wide variety of things. You've met more people. You just know more. That said, I think you can see investors who just get so set in their ways and don't open up their minds to fresh thinking, and I think that's very important. You have to do that, and I hope I've done that. So yeah, you do evolve. You do open your mind to a fresh way of looking at companies, and realise that black and white, just in a very grey world that we're in, doesn't always fit the bill. But I think Perpetual certainly has that reputation, but I don't think we were ever we were disciplined to that process. But I think we tried to keep an open mind, and there were certainly stocks that at first blush may not have looked like the typical Perpetual type stock, and we've carried that through, I think, into Airlie. Yeah.
Well, let's have a bit of a chat about the investment backdrop. For people that are watching, the reference point is where the day after the RBA has cut rates, which is to a new record low. And we have a situation where markets seem to be rallying on this sort of short-term sugar hits, but the sort of the bigger backdrop is not that favourable. It looks like US, the economy, there's a few question marks there. In Australia, there's plenty of issues with people a bit concerned about housing, lots of debt. We're not seeing that inflation impulse come through. What's your temperature check on the investment backdrop right now? How do you weigh up that short-term sugar hit versus the bigger picture?
Yeah, I mean, it's a fascinating investment period. I mean, the last 12 months have been quite extraordinary, in probably an extraordinary decade when we think about QE and the bigger picture. But right now, yes, certainly the economy has been softening over the last 12 months, and hence the interest rate cut. So when you look at valuations on their own in the market, and you go, wow, there's valuations are quite high relative to history, but relative to interest rates, things look attractive. Yeah. And it certainly seems that this low interest rate environment is going to continue. So that's supportive of markets, whilst the general economic operating background is not so supportive, I guess. So it's a real balancing act between those things. As an investor, you're picking companies to navigate the way through that. So it's quite interesting. You constructing a portfolio where there's not a zero chance of recession, but also definitely not a zero chance of very supportive markets.
Yep.
So it's a really tricky period to navigate. Then you step back and look at the last 10 years and the global situation. I mean, it really is extraordinary. I mean, this easy money, low interest rate environment. I mean, we've never seen this before, and how's it going to end? That's the the question.
The playbook for where we sit today almost looks like the most recent 10-year history, because you look at what low interest rates and falling interest rates, which is on the cards here in Australia, and it appears that that's where the US may be headed as well. That's been supportive for equities. So pin your ears back, right?
Absolutely. Well, that has been the playbook. You're absolutely right. But these things can change very quickly. I guess at the end of last year, it was total consensus that the end of QE meant we were going to get higher interest rates around the world, and so everyone was, I think, almost in agreement with that, all markets.
Yeah.
And so suddenly, we've flipped back to a much more supportive, easy money policy, and hence supportive for equity markets. And look, and the way it looks now is that will be the case.
I read an article, you'd been quoted in the AFR, the headline was 30% chance of a recession, which is a great headline, but I think I'd rather than take the bear stance, I'd like to focus on the perspective that you think there's a 70% chance that there won't be a recession. Yeah. Which is actually, I'll take those odds,
yeah.
I think.
Yep.
So what are some of the positives that you're out there meeting, you speak with companies, this is what you're doing all day, every day. What are some of the positives that you think people can focus on about the setup here in Australia? Yeah,
well, we probably cut that 30% back to 20% post the election. I think there was an issue around sentiment and confidence, business confidence, if the election had gone the other way. So I think the recession fears has probably faded even further. Yeah. It's really, again, it's in terms of the broader operating environment. You've seen those companies exposed to housing and the consumer have just been sort of shunned pre the election. And then post, we've seen a recovery in some of those names, the retailers and other sort of house building and home-related companies. Yep. So we've been, looking at opportunities pre the election for companies that were getting shunned. But generally, if I had to pick the overall theme is, certain companies are finding it a bit tougher as consumers sort of kept their hands in the pockets over the last 12 months or so.
You sort of talked, I know leading into the election, I read a few pieces, where you felt like a change of government was actually something that investors needed to consider and factor in, that it could be material. And I think you're vindicated to an extent when you saw the banks rally, high single-digit numbers, which is pretty big for stocks of those size to move. Have you, now that is locked in, the election, have you made many changes to how you're invested?
Not really. It's sort of, I think it's helped some of the stocks that we were sort of buying pre the election, thinking, with our, not feeling totally comfortable about it, but that's investing. You can't always feel 100% good about it. But it was, the companies that are more exposed to the consumer, and I guess it's just made us feel a bit more comfortable about that. But in terms of wholesale portfolio shifts, no, not really. The banks you mentioned, have rallied. Is that going to be sustainable? I think the APRA changes have helped again, and all this will mean that the housing market, the falls hopefully might have, be bottoming out, and that's quite, I guess, again, supportive of both the consumer and then, the market and a lot of the stocks in the market.
I noted some comments that the Treasurer had been leaning on the bank, saying he'd been picking up the phone, encouraging them to pass through the cuts and encouraging them to be supportive of borrowers. Do you see, you would have seen these relationships play out over many years. Do you see the government having much of an impact on how the banks conduct their affairs? Yeah,
look, I think the banks are totally under the spotlight of both politicians and regulators, and so that's not going to change in the near term. And so I was very pleased to see at least a couple of the banks pass on the full rate cut yesterday. I think this is good for the consumers, and it's good for the optics, around the banks restoring what are very damaged and bruised reputations.
One of the other things that we've seen is that there has been a surge, or there's been a bit of a spike in M&A activity, and I picked up on some comments that you made around the fact that spin-out companies or companies that have been demerged often go on to make great long-term investments. I was wondering if you could talk me through your experience with that, and why you think it is that they end up being such great opportunities. Yeah,
well, when you look at companies who make acquisitions, first up, I think the chances are that there's a strong chance that acquisition may not work, and particularly the bigger the acquisition, probably the even lesser chance that it'll work. So when we though look at demergers, so companies, spinning out parts of their business, I think it's nearly a 100% chance that it's better. I can't think of a demerger that really hasn't performed for investors over time. So the poster child at the moment is Dulux under takeover at $9.70. That spun out of Orica at $2.80. Aurora out of Amcor at $1, now at $3. Recall out of Brambles taken over at a much higher price. And probably the best of them all is Treasury Wines coming out of Foster's. So Treasury Wines' market capitalisation is now higher than what Foster's was when it was taken out by SAB Brewer. Yeah. So demergers just, they work because they've got, management can then get properly incentivised. They are focused. They're the masters of their own destiny. They can use their own cash flow to invest in the business, where before, as part of a bigger conglomerate, that cash flow might have gone back to the to the parent and got wasted somewhere else. Yeah. So demergers are just fantastic. And I guess when you look now, what are the obvious candidates to come out? Even though it's only just been put together, but I guess the lotteries business in Tabcorp is a good candidate at some point, maybe in the future. Mm-hmm. Probably the bank in Suncorp is a candidate to get spun out. Yep. So they're two that are sort of that are obvious to us at the moment.
And what about some of the existing spin-outs, things like Web Domain? There's South 32, Coles. Do you see these going on to having prosperous lives now that they've been spun out? They can be the single focus.
Well, the best spin-outs are the ones where the parent doesn't retain any holding, because then you get the takeover premium as well as part of that. So unfortunately, Domain with 60% owned by Nine Entertainment.
We can put a line through it.
Yeah, I think it's just, it may not, it just means that I think it's not as good. And Coles, Wesfarmers still retaining 15% ownership. You'd rather see these come out, unencumbered with no big shareholder there to really work. So there's the caveat on those two. And South 32, I think you'd have to again claim as a success. Yep. It had a rocky start, came out of BHP. I think first day of trading was about $2, fell to $1, but now here at $3 odd, you'd have to say that's been a good investment for shareholders.
You talk a lot about management being incentivised, and I know governance and good governance and the appropriate remuneration with management and boards is an issue that's pretty close to your heart. What is it about that aspect of investing that you find so engaging?
So I guess it's like any endeavour in business. There's certain big companies that will run themselves, I guess, no matter who's sort of in charge. It's the great Warren Buffett comment, I think, or that you've got to be able to invest in a company that any idiot can run, because someone will. But generally, any endeavour in life or anything comes down to the people involved, and they are the key attributes to whether it's going to be a success or not. And so it's about finding those people who can grow a company, who've got great capital management skills, who know how to read the cycles, who have skin in the game, and just good people with integrity and truthful and all these things that you're looking for. But really, that skill around executing, I think that's the big one, and with a sense of capital management and where they are in the cycle. Management, I think, particularly big companies, lose track of where they are in the cycle, and hence you see all this M&A or pro-cyclical investment. Yeah. And BHP and Rio, I guess, are the poster childs of that over the years, where they spend all the money at the top and then are hunkering down at the bottom when they should actually be out there maybe buying or investing. And
have you had experiences, or can you talk me through some stories where you've been able to engage with management and get them to come around to your way of thinking that's resulted in a good outcome for shareholders?
I don't think we can lay claim to a lot of getting changes. I mean, I tried for years to get Brickworks and Sol Pattinson to collapse that structure with no success. But I guess we talk to a lot of companies about the demerger aspect, and we talked to Wesfarmers about not demerging Coles but demerging Bunnings.
Yeah.
That was unsuccessful. But we're talking to companies all the time about their capital management, capital allocation policies, and how they can maybe do things better to add shareholder value. So that's something we're doing on a constant basis.
All right, my final question, and I do this to everyone that comes in for a chat. Can you talk me through an investing lesson that you learnt the hard way? Tell me about what went wrong, what the lesson you learnt was, and how it's made you a better investor today.
I think over 25 odd years, I've made so many mistakes. I've made plenty of mistakes, but I guess the key one, and this goes back to the point of you get better as an investor, I think, as you get older, obviously because of these hard experiences. But I guess the biggest lesson would be, selling when you know it's a sell. I think so many investors want to continue to believe the story, the dream, when the facts have changed, and their skill becomes realising that the facts have changed and have really changed, and just biting the bullet. It's a hard thing to do, and it's hard for professional investors. I think it's very hard for retail investors, but that's the key thing. That I've I wish I'd through hard experience, I wish I'd bitten the bullet harder on a number of stocks and sold.
Sold a bit faster.
Sold a bit faster.
So it sounds like to know when to sell, you need to have a thesis up front, know what your thesis is.
That's exactly right, and that thesis then allows you to be not distracted by what may appear appear to be a change in facts to a real change in facts. So if you know the thesis, if you've done the work, you know the story, you're not distracted by just noise. You're not jumping at every bit of noise, but hopefully you can recognise when that noise is not just noise. It's a real change.
Yeah, great. Well, thanks for coming in. Great to have a chat.
Thanks, James.